So when you think about investing, there's so many complications to it. And what I want to do in this video today is just make it simple. Of course, we could talk about IRAs or a Roth 401k or an ESOP or even an index fund or an individual stock, but I just want to talk about somebody that's starting today and what they truly need to know of what is really going to impact them over the long haul. So I'm going to walk you through 8 specific rules of thumb that you should use in all of your investing to make your life so much easier. And if you're wanting to take this one step further to maximize your financials, go ahead and look in the show notes below and you can actually book a call with my team. It's a free call and my team is going to assess if you're a good fit for the academy. There's a series of questions you'll answer before actually booking that call to see if you're a good fit, and we will qualify to see if we can help you. If we can, we'll schedule that free call and you will be able to join the BudgetDog Academy on that free call. And our average student saves an extra $19,000 per year. And of course, they take that and they maximize their investments, which then exponentially grow throughout time. And of course, we cover every single thing from A to Z of personal finance. So you map out exactly your financial roadmap to financial freedom. And that is the whole goal of the program. So I will see you there. So number one is really simple. And you might laugh at this, but it's invest in what you know. The reason I say this is because there's so many people online that will go invest in things they truly don't understand. They'll go watch the latest influencer posting their stock gains and they'll say, I want part of that, and they'll invest in that. And it's a sad way to invest because what happens is when the market gets rocky, they will panic sell. This is the same story that continues time after time. When you go to invest, make sure that you can explain that investment to a 5th grader. If you can't, you are not supposed to be investing in that. We need to have a core understanding of exactly what that investment is. And as long as you have that, there's nothing wrong with making that investment. Make sure your thesis is good and you understand from point A to point Z about which investment you're actually investing in. Number 2 is buy and hold low-cost index funds and ETFs. Sounds super simple. Instead of picking one individual stock or listening to the next guru online, just buy them all. And so you might be thinking, well, I could get a better gain with this individual stock. That's not entirely true, and I'll drop a statistic on you that might make you rethink this. From 1980 to 2014, 40% of stocks lost money, meaning you invested into the stock and you left with a loss. That's not too good. To further that point, over 60% of those stocks lost to the S&P 500, a simple index or ETF that you decide to hold, something like VOO, VOO, or VFIAX, which is an ETF and an index fund. But what's even crazier is that 7% of all of the stocks accounted for nearly all of the gains. That's a pretty crazy stat, and that makes you probably rethink betting on an individual stock. Number 3, dollar cost averaging. Let's break this down in layman's terms. Basically, I'm taking the same dollar amount and investing it on a periodic schedule. Think 401k, or maybe you have an automatic IRA set up. This is taking the same, let's call it $250, and investing every 2 Fridays from a paycheck and making your life so much easier so you aren't timing the market. So you may be asking, what if I buy it at a bad time? Well, by default, you're timing the market perfectly, kind of. So let me explain this. When you're buying the same dollar amount every 2 weeks, if the market's going up, you're actually buying less, and if the market's going down, you're actually buying more. So automatically, you're taking advantage of the market, and over the long haul, you have a lower average cost per share, which is the whole goal. And it makes investing super simple. You don't have to waste time looking at charts, and you don't have to waste your time investing. In fact, I don't look at any of my investments because they're all set up on automation. Our 4th rule of thumb is risk profile. So understanding what type of person that you are. So everybody wants the big gains until the risk associated with it plays out. Then they rethink, I probably shouldn't have taken that risk that I just took. So being able to manage your portfolio and your risk and making sure those align is super important. And there's so many different quizzes out there online that you can take at Charles Schwab or Fidelity or Vanguard. They give you guys insight into exactly what your allocation should be to align with your risk. So as you get bigger returns, that comes with bigger risk. And so finding a fine balance of what you're comfortable with taking from a return perspective along with that risk is the ideal type of way to invest. The average investor had a 3.6% return over the last 20 years, whereas the S&P 500, just the S&P 500, had a 9.6% return during the same period. So you might think it's 3x the returns, but ultimately with compound interest, it actually magnifies that effect, and it's pretty significant. So for example, if I took $100,000 today and let it ride for 30 years, and then I applied the average rate of return for an investor versus the stock market rate of return for the investor over the last 20 years, that would play out pretty sizable. And here's the numbers. $100,000 invested at the average return of the average investor would be 3.6%, right? That would get us $288,000 over the course of those 30 years. On the flip side, if we were just the market, that would ride to $1.5 million. We're talking about $1.2 to $1.3 million difference here. So it is sizable over the long haul. And there's many reasons why investors underperform: fees, taxes, but especially risk profile, and not aligning their portfolio with their risk profile. Therefore, making really bad moves, whether it be trading or panic selling, it usually ends up in a disaster. And don't follow the crowd. Following the crowd is a quick way to go broke. So the fifth rule of thumb is to choose 1 to 5 index funds or ETFs and diversify. Keep it super simple. You don't have to have a lot of different funds to have a lot of diversification. A lot of these index and ETFs hold thousands and thousands of stocks. So by default, you're kind of covering a pretty big base. For example, VTSAX holds 3,980 stocks, and an international fund like VTIAX holds almost 8,000 stocks. So it's more about market exposure in different areas that you want to get into, in different market areas or different segments of the market, but don't overcomplicate this. 1 to 5 index funds is totally fine to diversify appropriately. So number 6 is dividend reinvestment. And what does that mean? You might hear people say DRIP, dividend reinvestment plan. Reinvesting the dividends that you receive from your index funds or ETFs or whatnot need to be reinvested back into the same fund. Here's why. As you'll see on the screen, from 1960 to 2017, here's how $10,000 fared with reinvestment versus non-reinvestment of dividends. So with the S&P 500, if you reinvested the dividends, you would end up with $2.6 million almost. Whereas if you didn't, you would end up with $460,000. That's a sizable difference, obviously. I don't need to explain that. So reinvesting your dividends is a big part of long-term growth, and I am a big believer in total return versus just dividend return or just capital appreciation. We want to marry the two and make sure we have the whole enchilada. Number 7 is automating your investments. I talked about this a little earlier with dollar cost averaging, which basically a piece of dollar cost averaging is to automate your investments, but it just makes it way easier. So simply realizing the downfalls of being human and making this a robotic process. You get busy, you forget, you have emotions. Don't allow those to get in the way of investing. Every single week, every single 2 weeks, maybe every single month, have these automatic investments flowing. And that's exactly what I do. I don't invest manually at all. And everything I have is automated through dollar cost averaging. It makes my life a lot easier and I can sleep at night. So number 8, the biggest thing of all is don't sell anything until you retire, or you want to pool those particular funds for a particular purpose. And you have a goal in mind to pull those, not emotions, not rearranging your strategy, actually having a plan 10, 20, 30 years before you pull for when the time comes. If you begin to panic sell, if you begin to sell at different times, or you adjust your strategy, your long-term returns are going to be that of the average investor. And that's why you're watching this video, is we don't want to be the average investor. We want to be the average market, which is 3x the average investor, and in the top 10% of investors all time. Pretty good statistic to be in. I'll take that, especially if it's on automation and it requires no time. It's a pretty good trade-off that a lot of people leave untouched, and it's quite sad, but that's why you're here. So I hope it makes investing easier. And again, if you guys want to join the BudgetDog Academy, you can feel free to apply in the show notes below to take it to the next level and actually make all this come together in an easy, formatted, systematic way that is going to last you a lifetime. So with that being said, I will see you next Monday.